So, initial measurement. What we have here is I've entered into a contract with someone to lease an asset. What was your name again? Harris. Okay, so I've entered into an arrangement with Harris that he is going to lease me a car. And we figured out it's a finance lease. So we've kind of gone through all those judgments beforehand and said, yep, it ticks off the things that it needs to tick off. We're comfortable that it's a finance lease. What I have to do, because we're looking from the lessee's point of view, so we're looking from my point of view as the person getting to use the car, at the start of that, I have to show an asset and liability. So I'm going to debit asset, credit liability. You can call them a lease asset, lease liability, but for what we're talking about now, I have to show an asset and I have to show a liability. The issue is how much. And how we do this is we have to find out two numbers. The first is the fair value of the leased property. So if what Harris is leasing me is a brand new car, and we know the fair value of that brand new car is $30,000, that's the fair value of the lease asset. So that's given. We then have to go and find out what the present value of the minimum lease payments are. This will just need to step through a few things as to how we calculate that. They talk about the discount rate. Is the rate implicit? We will give you the discount rate. You don't need to figure out anything with that. Any initial direct costs are added to the asset. We're probably not going to see too many initial direct costs in the examples that we use. But if you do see any initial direct costs, you add them to the asset side, not the liability side. And I suppose because we like to make everything as consistent as possible, think about what we know about property, plant, and equipment costing. Everything that we do, all those costs which are directly attributable to get that asset to where we need to use it, get added to the cost of the asset. So that's not dissimilar to that idea. It's those direct costs to get that asset to where we need to use it. So it gels in that sense. Now this bit, even though it's a fairly small and an innocuous line at the very bottom of this page, without this, pretty much all that we've talked about before is almost useless. Because what set-off is, and we didn't explicitly talk about it too much in financial instruments, but a set-off is basically allowing you to net two things off. So if you have an asset and you have a liability and you are allowed to set them off, it means you could go, I've got an asset of 100, I have a liability of 90, I can set them off, I show an asset of 10. So that's all that set-off means, and we are going to see set-off again next week in tax. So if this didn't exist and companies were allowed to set off, the whole purpose of this is to get them to get an asset on the books and a liability on the books. Now those assets and liabilities crop up, if we ignore this for a second, they're exactly the same amount. So if we said you had an asset of 100 million and a liability of 100 million, but you could set them off, you would have a $100 million asset, a $100 million liability gives you zero. And they wouldn't show anything, which defeats the whole purpose of what we're trying to do here. So it is actually a really important part of it. Now, minimum lease payments, and we need the present value of them. So remember, I borrowed a car, well, not borrowed a car, I have hired a car off Harris. As part of that deal, he's worked out and said, okay, you are going to pay me, I don't know, $100 a week for the next 3 years. That's the money that we're talking about with the periodic payments. So if you're renting your flat and you're paying your rent fortnightly, or you're paying your rent monthly, that's those periodic payments that you're paying. Now I'm going to draw this. Right. Okay, so we've got the three payments. We're going to ignore at this point unguaranteed residual. We don't need to talk about it here. It is not part of the minimum lease payments, but it does become important in a few slides' time. So periodic payments. So Harris has leased me a car, and I'm going to pay $100 a week, and there'll be a payment. Oh, actually, because I'm paying in advance. Generally, with a lot of leases, you'll pay before you get to use it, not after you get to use it. Not always the case. So I've paid $100 a week for however many weeks. Those are my periodic payments. Now, what a guaranteed residual is if, as part of that contract, and you don't always see this in a lease situation, as part of that contract, I've in essence guaranteed how much asset he is going to get back at the end of that 3 years. So in 3 years' time, if, for example, just pulling numbers out of thin air, how much do you reckon a $30,000 car over 3 years would be worth, what, 20-ish, thereabouts? Okay, so say as part of the contract we've got a $20,000 guaranteed residual. What that is said is that I, as the lessee, have to make sure at the end of 3 years he gets something worth $20,000, or at least $20,000. So because it's guaranteed, it is the minimum I have to pay as part of the things that I cannot avoid. Now, there are multiple ways this could happen. At the end of 3 years, I could go, I don't want your car anymore. I'm not, there may have been an option to buy it, there may not have been, but I don't want it. Here's your car back. Harris goes, hang on. Well, first up he goes, okay, the car's worth, he gets it valued, it's worth $20,000 or it's worth $25,000. We're good, we all go on our separate ways. The alternate option to that is the car isn't worth $20,000. So at the end of 3 years, the car's only worth $15,000. At that point, I give him the car back, and I've got to make good another $5,000 in cash, because I've got to make him make up for that $20,000. So regardless of if I give him the car back or if I give him cash in the car, he's getting $20,000. The alternate is I turn around and buy the car and just say, look, for $20,000, instead of giving the car back, I am just going to basically buy it. Here's $20,000. We walk away. He's still got $20,000 there. So that $20,000 guaranteed residual is a minimum lease payment because of that. Now, for the next bit, for bargain purchase option, I'm going to show you, instead of talking this through, I'm actually going to show you a picture and get you guys to help me out here. So, laptop. Hopefully I left the picture in. Okay, so imagine this was a car that Harris leased to me. Now, from memory, those are about brand new 200-ish. I mean, they're expensive. My question to you, at the end of 3 years, if you lease this car for $100 a week, which is probably pretty unlikely that's the sort of thing that they're going to charge, if you were given, even just right now, if I was to walk up, if I had this car and I said, would you buy this car? It is in good order, it's been used for 3 years, but mechanically it's sound. If I were to offer this car to you for $20,000, would you buy it? It's not meant to be a trick question.
Because I have to check for the fair value of the car.
Okay, let's just assume this is definitely under fair value of the car. Like, let's just say this is going to be about $150,000 fair value. And I was giving you the option right now to take it away for 20. And it's not, I'm not going to kind of come looking for anything else. This is a legitimate deal to buy it for 20. Who would buy it? You would, not everyone? Yes? Hell yeah, you'd buy it. You'd be stupid not to. Okay, if you didn't particularly drive, and I've actually stopped driving now for the most part since I got back. If you didn't particularly want it to use for driving, buy it for 20 and just flog it off straight away. And you've made yourself 130, okay, maybe some, like, you don't get a good deal, maybe you sell it for a little bit less than that. You've still made a good amount of money. If you do actually want it, you've got a really good deal on a car. So a bargain purchase option, even though it is not something which you are compelled to do. So if this was a car Harris had leased to me and said, look, I'm giving you an option to buy it at the end for $20,000. I could walk away from that if I want. But the accounting standards basically go, no one would be that stupid to do that. Everyone will exercise that option because it makes you money in one way or another. So a bargain purchase option is part of a minimum lease payment because they just assume you will use it and that money will go out, because I suppose they assume people are meant to be somewhat rational.